Shares for beginners. Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
It is hard work. It is challenging. And it can be very emotionally charged. But understand that, plan for that, account for that. It can also be extraordinarily rewarding. You're just not going to get that reward if you're demanding the instant gratification, if you're naive in the volatility that you should expect and all of these things. Again, this is really obvious kind of stuff, but there's those that know and there's those that know.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. How far into the future can you really see? Are you a long-term investor looking at 5-minute charts? Do you need time to relax more? Joining me today to look at the gentle art of artisanal investing is Andrew Page. G'day, Andrew.
G'day, Phil. How are you?
God, I can't resist that joke. I love saying it like that.
I love it. Lean into it.
So, Andrew, he is the founder of Strawman.com, a private online investment club designed for those passionate about taking control of their financial future. Andrew's built a reputation for uncovering hidden gems in the Australian share market, offering unique insights through detailed research and a community-driven approach. Now, we're going to be talking about that and investing in general and the latest blog post, but both of our situations have changed markedly in the last year, haven't it? So, I mean, I've moved up here to the Sunshine Coast in southeast Queensland, and you're in the lower Blue Mountains just west of Sydney.
Yeah.
What's it like?
It's beautiful. I wish we had done it a lot sooner. It was an economic catalyst for the move. And at the so we've been in the inner west for forever, and we love it there. It's a really great scene, as you know, but as you also know, things are a bit crazy for the Australian property market. So it was a choice of pretty ordinary 2-bedroom unit or a 4-bedroom house on a big stretch of land next to a national park. And for someone who works from home, it was a no-brainer. So we made the move. And yeah, as I said, it was the best thing we ever did. I just wish we'd done it sooner.
And I believe Bitcoin had a bit to do with the helping you to make the move.
Yeah, well, it did. And the share portfolio as well. I'm fortunate enough that it's been a pretty good run.
It wasn't Pro Medicus, was it?
Not so much this time around. Pro Medicus it definitely helped build the business and provide the capital for the business. But yeah, Bitcoin did a lot of the heavy lifting on this one, and it was hard to let go. As much as money, capital, investments, it's there for a reason. It's a means to an end. It's not the end itself. But when you're addicted to compounding, as I am, it's very hard to let go of something that just continues to compound along. So, but look, as I say, it was no regrets.
And the difficult part, and this is after spending last evening wrestling with a chainsaw.
Yes.
You and I, we're both inner westy kind of guys. We're inner city guys. We're not used to all of the hardware in this kind of life. I mean, how do people live this way?
Yeah. Well, you know what? I'm loving all of that hands-on kind of stuff. It is something very satisfying about it. It's also been quite educational, if I can admit that too, Phil. Like just, when I'm tootling about our house and I'm doing stuff, because again, I've been a renter for forever. We've talked about that on previous episodes. I've never really been a tool guy. And once you start needing to do stuff, you realize how much of a game changer tools are and what a productivity accelerant it is. And it's just, I can't help but draw many analogies with the global economy when I'm, again, tootling about my place going, oh, this is how we as a society get richer. I can use this chainsaw and I can chop up enough wood for the entire winter in an afternoon, or I could use an axe and maybe get enough wood just for tonight, right? And I know that might be like a little bit of a stretch to draw that metaphor to the broader economy, but that really is it. And when you have those direct experiences, I mean, look, this is beyond the scope of your question. It is a lot of fun. I love doing all of that kind of stuff. But it was a nice reminder of just like, wow, technology is really the lever that gives us everything as a society.
I think it's also what I'm finding, well, first of all, not having the pressure of a mortgage, which is great.
Yes.
And then secondly, doing that kind of work, even though, I bitch and moan about it quite a bit, it does give you time to think and
Yes.
it does give you time away from screens.
Oh,
And
yes.
I think that's why when I was thinking about the introduction to this episode, is that having time to think and to slow down and to have a
100%.
much easier, slower pace of life does really help your mental health, doesn't it?
I 100% agree. Actually, I was having a chat to a friend the other day, and they work in the industry. And one of the pressures with the finance industry is that, and in particular in the game that he's in, you've got to deliver recommendations all the time. You know, it's another month, it's another recommendation. What should I buy now? What should I buy now? You've got subscribers, they want content, and that's all good and well and perfectly normal, and that's what he's signed up for. The trouble, of course, is that in the market, it's not an even distribution of good ideas that come along. You might go for years without a single good idea, and then in a month find 10 great ideas. And between all of that, there's a lot of sort of thinking that just needs to occur. It's why Buffett moved from New York back to Omaha, right? Like, it's just to get away from it, because we're in a world now where there is no shortage of information. There's an information overload. And just to be able to distill all of that and draw out the signal from the noise is so incredibly valuable. And also just to work on your own schedule, just to wait for an idea to come to you where you can have immense conviction in it, where you don't have to force it, where you can wait for that flower to blossom, so to speak, and then go hard all in, right? You know, not all in 100%, but, you know, like really know what you own and why you own it, and be confident in that, rather than, oh my gosh, it's a new month, I need another idea, and it needs to be a new idea. And it's just like, the reality is, I think anyone who's been doing this knows that that's just not how it is, and it can be very stressful. So the ability to sort of distance yourself from all of that rubbish and just allow things to take their natural course and not to have to force these things, I think is just such an incredible edge. And yeah, I'm really grateful for it. If anyone out there is listening, I would very much encourage you to try as best you can to adopt that mindset. It's particularly hard, Phil, like if someone's had an inheritance or they've come across a little bit of money, you know, redundancy payout or something, you know, and it's just like, oh, I've got to invest this and I've got to invest it now. And it can force you to make decisions that you later regret, but just to sort of, as I say, give yourself room for contemplation, give yourself time for those ideas to knock about the old cranium, and be ready when they're ready, as opposed to when you need them to be ready. And those two will rarely line up. But if you can have that discipline and that patience, I think you're much better for it.
And one of the great statistics I heard last year, I think it was, and the figures might not be exactly correct, but you get the idea, is that looking at 100 years of ASX data, only 7% of companies have actually delivered returns greater than the underlying cash rate.
100%. Yep, absolutely. And the other interesting part of that too, you dig into that, it's of those 7%, it's not as though they were always performing well. Even within that group, there are long stretches where nothing happens, or in fact, maybe a big drawdown happens and it sits there for a few years. 5 years later, you look back and it was obviously an incredible return, but it often doesn't feel like that along the way. So this is a game that will psych you out again and again and again. And, you know, you go to sleep, the demons will come. You know, have I got it right? What am I missing? You know, have I got that 7%? And is it reasonable to expect them to perform the moment that I buy them? Or will it just take time? And yeah, I've often thought that the biggest challenge with the game that we're in is not so much the intellectual, but the emotional and the behavioral are really the big challenges. If you can get that part right, you've got a massive edge.
I just wanted to go back a little bit to, you mentioned your friend who works in the markets and who's under constant pressure to come up with a new idea every month. And I mean, there's two parts of this. First of all, there's the financial industry that wants to keep feeding people ideas and feeding the beast of financial trends and financial recommendations. But it's not just the financial industry's fault. It's because people want that as well. People want to hear stories. They want to hear about companies. They want to hear ideas rather than put in the hard work themselves. So a lot of people want to blame the financial industry for doing this, but I also blame people themselves for asking it. And, I just had a guest on who's a
Yep.
financial advisor, and he goes to barbecues, and of course, he always gets the question, what do you think about the market this year? And we all get that, don't we?
Yeah.
We all get those people coming up and talking to us about what's the idea, what's going to be that game-changing stock pick.
Yep. It's the same in politics. The old saying is you get the politicians you deserve. I think you get the financial services that we deserve as well. I mean, the old saying, Phil, in the industry is when the ducks quack, feed them, right? And I can tell you, because this is sort of the path that I've gone, if you're out there with a service in this space and you say, hey, listen, it's really hard. Most of the ideas that we generate won't work out. The ones that will work out won't work out immediately. And even when they do eventually work out, it's going to be scary. Do I take profit now? Do I let it run? It's going to be extraordinarily volatile. And, after 10 years, you could probably, if you're pretty good at this game, you might get 10, 15% compound per annum on average. That's not an enticing sell. As opposed to, hey, come buy my service and this thing's going to the moon. We're going to make you rich tomorrow, risk-free. Now, it's not said like that, but that's very much the offering and that's put out there. And it is because it works. Do you want the truth? It's like that old New Yorker magazine cartoon where it's got those two booths. One says easy but wrong answers and complicated but right. And everyone's lined up along the easy but wrong. And we all know this. I'm not shattering any illusions for anyone listening, but that's just the monkey part of our brain. We want immediate satisfaction. We want easy answers. We want to believe that we can have our cake and eat it too. And of course, that's great. I would love to have no risk, high returns, instant returns. But unfortunately, it's not the world we live in. It's also why it's an industry where the churn is just unbelievable. So you will have clients come in and then you'll have clients go out. The retention rate is very low. Partly it's because a lot of people out there provide very bad advice. So after a while you think, what am I paying for? This person's not providing a good service. But even when you provide a good service, you'll often see people churn out because they don't fully appreciate what the journey is like. Hey, I've got a bit of money. I want to invest. I've heard the share market can offer some good returns. Sign me up. Okay, I've done pretty well, but I didn't know it was going to be that scary. I didn't know that like 3 or 4 or maybe even 5 out of 10 of the investments aren't going to work. It's horrible. It's like, so yes, I've made a bit of money, but I'm just going to take it and go into something that's seemingly less risky, like property or something else, because I don't get a daily ticker. I don't get a daily quote on the price. So it's just the way it is. And again, I'm not saying anything that's new here, but if you can really, really own this idea that it is hard work, it is challenging, and it can be very emotionally charged, but understand that, plan for that, account for that, it can also be extraordinarily rewarding. You're just not going to get that reward if you're demanding the instant gratification, if you're naive in the volatility that you should expect and all of these things. Again, this is really obvious kind of stuff, but there's those that know and there's those that know. And if you really know what I'm talking about here, and understand that and appreciate, know what you're getting in for, it's a hell of a journey. But as I say, it's a life-changing one. It's changed my life for the better. I'm not pretending I'm Warren Buffett, but again, if you can do the sensible thing and you can do it consistently, you don't need an IQ of 180, right? But if you can just stay the course and just consistently apply a reasonable, sensible process, you will get there, right? I often liken it to exercise, Phil. I'm the furthest thing from an exercise junkie that there is, but I can guarantee you that if you cut the sugar out, maybe try and do a little bit of exercise every now and again, go for a walk a couple of times around the block, I don't know, do some push-ups, you are going to get healthier. You're going to get fitter. It's not like you might, it's like, well, if I do this, we'll see how it goes. You are guaranteed to get healthier. But guess what? It sucks. It's really hard work and no one enjoys doing it. It's not as fun as sitting on the couch and eating Tim Tams, right? But the results are guaranteed. And I think it's a really good analogy with investing in the market. I would certainly not use the word guarantee, but as close to that word as I could get Even if it's just ETF, broad-based low-cost index fund. If I'm just going to consistently save and dribble it into that, again, I can't use the word guarantee for legal reasons, but as close as I can get to that word over a 10-year time frame, you're probably likely to, on a relative basis, do reasonably well. Most people won't stick with the journey, as they won't stick with the diet or the exercise, because it's hard, and it really is. But as I say, if you can appreciate and understand that, and you can be persistent, the rewards are there.
Super is one of the most important investments you'll ever make. But how do you know if you're in the best fund for your situation? Head to lifesherpa.com.au to find out more. Life Sherpa, Australia's most affordable online financial advice.
I feel like sometimes, Andrew, that I'm saying the same things over and over and over again. And I'm going to do a piece called You've Been Told. At least you've been told. Because this is what I want to try and point out to people, is that there is not going to be there's no easy answer, and that you just really need, if I can just get it through someone's bone head once in a while, that it's harder than you think. There's no way of just investing in individual companies unless you've got a lot of experience and, like you say, doing a lot of exercise. Yep. Anyway, I'll get off my pulpit for now.
It's a hard thing. It's a hard thing. For 100%, I'll double down on that. Like it is. And the frustrating thing is, you can lead a horse to water, you can't make it drink. So people need to be receptive to the message, and then they need to really own the message, and it's hard. But I think most people will come around if given half the time, but you've got to meet them where they're at, and you're at the right time. And the other thing, this is particularly, you mentioned Bitcoin before, like this is most definitely true in that space, right? Like, once you see it, it's very hard to unsee, and you just want to sort of tell everyone, it's like, oh my gosh, this thing is like so exciting. But 99.999% of the time, you just annoy people and they're not ready to hear it, and you sound like some weird cult member. So I've learned the hard way that what you do is you just sort of like, you can push too hard. It's like having kids, right? You can lecture them all day long, but at a point they're just going to tune out. So you've got to wait till people are ready for the message, I suppose.
Okay, so getting back to the blog post, and again, this is all about what we can do and what we can't do. And it's called, the blog post is 4 Inches to the Future, which is what I'm going to name this episode as well, just because it's a cool name. Mm-hmm. In a 2014 interview, Lloyd Blankfein, the CEO of Goldman Sachs and part-time Bond villain lookalike, we'll find out about that too, was asked a simple question: how far into the future can you see? Now, given Goldman's reputation for spotting market trends before most, you'd expect a confident answer. Instead, he deadpanned, I don't think I could see 4 inches into the future. Now, I know we're mixing our measurements here, but it was really, sometimes people in the financial industry aren't that honest. I know a lot of commentators who seem to, they're quite cavalier in making their predictions.
Yeah, it was a really profound statement that he was making here, and I've gone blank on the interviewer now, but they were basically saying, listen, Goldman's got a really good reputation of making the right calls. And look, at the end of the day, investing is making a bet on the future. You are literally putting money on in the hope of a certain outcome or a set of outcomes coming to fruition. So it's a very logical thing to think. It was like, wow, these guys are really good at predicting the future. And he wasn't being coy. He went on to say, and I hope I try and convey this in the article, is that he's saying that it's more about scenario analysis and contingency planning. So why wedge yourself to one particular vision of the future? Here's the situation as it currently stands. By the way, that is a hard first step. Like, it's called nowcasting as opposed to forecasting. Where are we now? What is the current state of play? Which is not easy to always figure out. But then from there, it's like, what are the possible futures? You're never going to predict every possible future. And of the futures you do predict, you're never going to get it right. But you're trying to sort of think, where could this possibly go? And you're gaming it through in advance, going, well, let's take the tariffs, for example. Maybe Trump doesn't blink and he increases it. What does that mean? And then what? And then what? And then, okay, well, what if he does? Okay, well, what does that mean? And you've thought it through. So when the future becomes the present and that those outcomes crystallize, it looks like you've predicted the future. But what's really happened is you've just been very quick off the mark. Oh, this has happened. Okay, right. That means that this is the scenario. We're going down this path. Okay. And these are the positions we're putting on. Everyone else is going, oh my gosh, this just happened. What does that mean? Okay, now we've got to figure it out. I guess we should, start thinking it through. Whereas if you've pre-thought it through, it feels like prescience. And I'm very big, I've been harping on about this for forever, but I'm very big on this idea of trying to, especially in terms of risks, what can go wrong with my investment? What are the things that I need to look out for? And if they happened, what does it mean? Is the thesis completely busted? Is it a bit of a speed bump and we'll go on? It means that you don't know if these things are going to unfold in the way that you've accounted for. But if they do, you can act instantly, very quickly. It's better than forecasting, because otherwise you're saying, I need this specific set of outcome to occur. And if it does, I'll make money. And if it doesn't, I won't. And that's a much more difficult bet, rather than just sort of saying, listen, I think this is going to happen, but this could also happen and this could also happen. And if these things happen, here is my plan of action. I've got a battle plan already worked out. And as I say, it looks like prescience when you do it well. And it's just about thinking through all these different scenarios. And then, as I say, sort of like having a very high level of situational awareness to let you know which path we're heading down. It's just super powerful. And that's what Goldman has been very, very successful at. And as I say, it looks like they're just great forecasters. They're just great contingency planners.
It's interesting that you're sort of looking at situationally, like if you're going to try and work out what's going to go on with tariffs or anything, the nowcasting that you're describing, you could drive yourself crazy. And there's no guarantee that you're going to be right about anything. I mean, you might feel something, but there's no guarantee on that. No. I was talking to another investor recently, and it was quite interesting the way that he was putting it, because he only works basically always on the company fundamentals. Mm-hmm. All of his investing's based on what he can read in the annual reports and the company reports and the quarterlies, because he's doing US stocks as well. Mm-hmm. And it's interesting that it seems like what would seem to be top-down trends can be identified out of the bottom-up approach, out of those numbers. Like for some reason, he's quite overweight shipping stocks at the moment. And it's only because the numbers are saying that here is a trend that has appeared out of the numbers, rather than someone thinking, out of the tariffs, well, shipping stocks are going to be undervalued, Sorry, I'm getting a bit confused here in trying to explain, but you know what I mean?
Yeah.
The numbers themselves might actually show what is happening and affecting these companies in the real world.
Yep. I mean, it's very scientific, really, isn't it? This is how science works. Here's my hypothesis, and I go to look for confirming evidence that confirms or deny it. And then I can hopefully build up a reasonable theory that explains things around that. I mean, it's all narratives. We're story-driven creatures, so I can tell you about a stock or investment that I like, and I can give you a pitch, but I'm really just telling you a story here. And, the way the human brain works is that, we don't gravitate towards necessarily what's right. We gravitate towards what's compelling. So you've got to have a good story, A story can be good and wrong, or it can be good and right. It's right if, as the future unfolds, there's more and more evidence that confirms it. I think this is going to happen. Here's my narrative of the future. Here's the framework that I'm working at now, rather than just go, I am right because I'm God's gift to investing and, I'm a genius and this is the only way it can go. I'm just going to look for evidence along the way that refutes it or confirms it. If it refutes it, no harm, no foul. It's investing. It's a probabilistic game. Got it wrong, I'm out. Or, oh no, actually this turns out that this is the case. I did think that they had a good product, and now I'm seeing in the latest quarterly, there's been some good sales momentum there. Customer retention has gone up. Average revenue per unit is going up. These are all signs that confirm that you are on the right track. There's no guarantee. So yes, I think that's a very good approach. Of course, all of these things in any fundamental based approach are always backwards looking. Right? They tell you what has happened. We measured something. Here it is. We're presenting it to you. This is what happened last quarter, last half, last year. And of course, you can't go back in time. So you're buying shares today. And is it going to keep happening? But if you can fit a narrative around the facts and they fit really well, like any good theory should accommodate all the variables really well. It's just something to give you a boost of conviction and know that you're on the right track. Unfortunately, the easiest person to fool is yourself. And I'm a sucker for this as well. So I thought this would happen. The evidence comes out in a way it's like, gosh, it's really not confirming what I thought. But you would be amazed at the mental acrobats that one can do to preserve one's ego. One is necessary, particularly if you're male, right? Girls are much better at it. But yeah, we're rather pig-headed as males. And so it's something that I'm constantly on the lookout for is like, you know, there's just a fine line between conviction and stubbornness, I think. And you've got to have that intellectual honesty to kind of go, listen, it's just not playing out the way I thought. It's time to rip the Band-Aid off here. It's hard to do.
Yeah, just another tortured analogy that I've thought of while listening to podcasts doing garden work, because I'm fascinated by black holes. But the amazing thing was that they were predicted in 1916. Someone took Einstein's general theory of relativity.
Yeah.
And this was a mathematician who was in the trenches in World War One. There was a colleague, and he was sitting there just playing around with the maths and said, you know, what happens if a star sort of collapsed in on itself and all of its mass was at a single point, and just doing a mathematical game. And it turned out that was the maths that predicted black holes. Now, you know,
that's the sign of a
I
great
guess the
theory.
analogy, the tortured analogy that I'm trying to make here is the same with investing, is that the maths can show you something that might be confirmed in the future.
Yes, absolutely. I mean, look, a good theory should describe what you see, but a really good theory should be able to make predictions and unexpected predictions as well. So that is why I think we can look at something like the general theory of relativity and say, yeah, look, it's not perfect.
It's amazing how much it's been confirmed in so many ways, just from thought experiments, the power of the human mind.
Unbelievable, you know. And so you wonder why people get to a point of, you know, it's just like, oh no, this is right. This is a very accurate, maybe not complete, because we don't have a complete description of nature, but in the domain that it tries to explain, in the realm of the very big, general relativity is an incredibly potent.
Yeah, let's not get into quantum.
Quantum. But quantum too has got some very interesting. So my background is in science. You shouldn't have set me on this path. I've got a degree in microbiology, so I love science, and I've spent a lot of time thinking about. Like you, I listen to a lot of science podcasts and stuff as well. But yeah, with quantum, I mean that predicts all kinds of weird stuff, but it's right. And just to bring it back to investing, that's the sign of a good investment thesis as well, right? It's just sort of like, if you've got a good vision or a good mental model of the world, and you've been able to position a company within that and reasonably estimate some likely paths that it would go, you know that you've got a good model, right? It just, you kind of have to, because if your worldview is that wrong, any predictions that come out of it must also be wrong. If you've got a good, you know, understanding of the world and the way it works and the human world, I'm not talking about like the fundamental forces of physics and nature here, it should have some predictive capacity to it. And that's why I've always found investing so fascinating, because it goes beyond, it's often sort of seen as some degenerate gambling kind of activity, but I find it fascinating because I've always had a deep hunger, I suppose, for the truth. And as I've gotten older and as I've invested more, I think my understanding of the world and business and the economy has gotten better and better and better, which helps me get better returns, right? So there is a purpose to it all too, but it also, you can look back on it and go, gosh, I mean, my understanding must be broadly true. Otherwise, this is the most, you know, improbable set of results that could possibly, if you've got a really bad vision of the world, but you keep getting good returns, like you're just extremely lucky. More likely is you've got a good returns because you've got a good vision of the world. That's why I think when Buffett or Howard Marks or any of these great investors start talking about what they think in terms of policy decisions for the economy, and I listen to them far more than any ivory-towered economist working at a major bank who has never owned a business, who has never been in the real world. I mean, these investors clearly have a good understanding of the way things work, because if they didn't, they wouldn't have the right returns. So it's a lovely comparison. And it's one of the things that, particularly more later in life, it strikes me as some of the very dominant theories in economics are still uttered with a straight face, because they have been so demonstrably, to my mind, shown not to be true, by virtue of the fact that all the economists who subscribe to these philosophies are just consistently wrong in their forecasts. I mean, that just to me says, well, you're wrong, right? Like, you're not that particular outcome that you predicted was wrong, but they're almost always wrong. So therefore, your theory and your hypothesis and your understanding must also be wrong. And it's really striking. It really is amazing. Like, some really bad ideas are so pervasive and dominant still, in spite of this massive wall of evidence to the contrary. It's frustrating, but at the same time, I think it's quite exciting, because if the world was a purely rational place operating under a very accurate model, there wouldn't be much opportunity for outperformance. So we should be grateful that there are misconceptions of the world, because as direct investors, it provides alpha, it provides opportunity.
It's amazing, isn't it, with economists, that so many of the theories assume that people act rationally.
I know. It's just, how much evidence do you need? Right? Oh, no, it's absolute pure madness. But, they say science progresses one funeral at a time. It's very hard to change the mind of someone who's dedicated 40 years of their life to a particular ideology or philosophy in economics. But, we'll get there, hopefully. Some of these ideas have been kicking around for a long time, and they refuse to die. And it frustrates me in the sense that, on one hand, as I say, it's good if you're looking for outperformance. It is frustrating because these things very much have a real world impact on our standard of living and the way that we allocate very scarce resources amongst our population. And, we've done very well as a species, but it's frustrating when you think that we could do so much better if only our politicians and institutions and powers that be had a better grasp on reality. We could avoid a lot of unnecessary pain and a lot of unfairness, but this is the system we've got.
Track your investments like a pro. ShareSite is Investopedia's #1 portfolio tracker for DIY investors, simplifying your finances. Get 4 months free on an annual premium plan at sharesight.com/shares for beginners. So when Scientific Andrew is looking around at the share market and looking at different companies, where is the absolute beginning of where your filtering process starts? I mean, do you have a checklist or something?
Not really.
What do you do? Or are you just sort of browsing around, or are you looking at anything?
Vibe investing, Phil.
Yes, good to see.
Vibe investing. No, look, I used to be a very formulaic kind of investor. I'd like to look at various ratios and numbers, and it's very strict. It had a certain appeal to it. But as I've gotten more experience, it's not that I don't, absolutely, I look at all of the numbers that I possibly can, but you realize, I suppose, that the really important things are never to be found in a spreadsheet. It's the qualitative things. And look, I'll rattle off some things, and I'm sure you'll be in 100% agreement. Quality management. Without quality management, you just have to have a business and institution that's so robust that it can withstand such idiocy. So it's one of those things that everyone goes, oh yeah, quality management, I want that. But that's not obvious. There's no metric for that directly relates to that, Or I want a deep moat, a strong competitive advantage. It's like, again, there are signs that indicate that there might be a moat present, but there's no one specific measure that will tell you these kinds of things. So they're all qualitative kinds of things. So I think what I really do these days is I try to stay in my lane, because the world is a very broad, complex place, and my circle of competence isn't that huge. And as Buffett says, you don't need a big circle of competence, but you need to know where the boundaries are. And over time, I've just learnt that there are some things that I just don't have the capacity or the skill to divine with any great accuracy. Things like mining, things like biotechnology, they're just very, very, very difficult places to invest, not because of any malfeasance or incompetence that might belong to a particular sector. It's just that it's a very, very difficult game to play. What's the price of silver going to be next year? I've got no clue. How much is going to be found? What's the cost of production? What are all the 1,000 things that I have to guess, right? It's super hard. I do better in areas where the business has a far more, or at least a capacity for far more resilience and dependability in earnings, and where the economics is very attractive. And while I said before, you can't go backwards in time, there is at least some evidence to show that the strategy is working. The product, the service is desired by the market. People are buying more of it. They're sticking around. They're paying more for it. And management are doing it in a way that's highly efficient and accretive to shareholders. And I guess what you're trying to do is pattern match. You're looking for pattern recognition. What is it that I really want here? And it's something that, again, like to go back to our initial conversation, it's not something you can force. So generally speaking, ideas just land on my lap because someone is talking about it. And you'll go, oh, that's interesting. Maybe I'll learn a little bit more. Oh, that's interesting. And you just keep going. You follow your curiosity. I'm really bad at if someone says, okay, you need to look at this company. And if I'm not interested in it, or there's a few heuristics that are going off that just make me, again, through experience, you just know this is a tough industry and a tough sector, ultra competitive, hyper cyclical, massive capital intensity, all of the things that you just really don't want in a business. It's hard to sort of go on and do the work with that kind of stuff. So, you'll be at a pub, you'll be at a barbecue, you'll be at a friend's house, online, listening to a podcast or YouTube, and someone just mentions a stock and your ears will just prick up. And you'll just keep scratching at it until you either get to a point where it's like, now I'm really interested. I want to own this thing. Or no, I'm not interested at all. And so it's something, I'm all over the place in my answer here, Phil, but I'm really just trying to sort of say it's a very organic process for me. It's just a question of following my curiosity, applying some high-level heuristics, and just keep going until I reach one of those two end states of either not interested. And not interested might just be, I'm fascinated, but I don't understand it. It's just, it's too hard basket. Most of the things that I come across are just too hard for my small, feeble mind to wrap my head around. So it just goes off. Or I'll come to a conclusion that, no, I'm pretty high conviction on this. And I'm also a pretty concentrated investor. I'm not afraid to hold less than 10 stocks. And at this point in time, I've probably got more than half of my wealth in just two assets at this point in time. Not by design, but just the way things have gone. But I'm comfortable with that. I recognize that the good ideas are rare. And when you do find one and you do see increasing evidence that it is executing well, then it is not a horse you want to get off anytime soon. And rather than being someone who has a portfolio of 50 stocks and I'm sort of like a jack of all trade, master of none, and know a little bit about all of them, and it has not appealed to me. So again, I let it come to me every now and again, and it is a rare thing. And every now and again, you will come across something which just captures your imagination and fires you up, and then you go hard. There's no point in my mind of doing a bunch of research and then allocating 1% to it. Or it's kind of like, well, let's say 10x's. Like, it doesn't really move the dial for you, does it? I want something, recognizing how rare a good investment is. If it goes well, then it's going to have a material difference to my wealth and my lifestyle. And I'm not saying I bet the farm and they're all on flyers and that, but it's quite Buffett again. He talks about diversification. And it's a sacred cow that I feel like I'm killing here. I'm not saying. I
know we're all supposed to be diversified, but no, I mean you've got a great deal more expertise than many people. Many people use diversification as a way of managing risk. Where
it's a hedge against ignorance, they say.
That's a great way of putting it. But you've got so much conviction because you have actually put in the work. Okay,
I'm still wrong very often. Let me be clear on that. I can be high conviction. I've been wrong on very, very high conviction ideas. But yes, I do think I got to be careful here actually, because they're different horses for courses, right? Different people have different approaches, have different levels of interest, have different resourcing in terms of their time, etc. But for me, I very much like to be very concentrated. I very much like to have a small basket, but one that I watch like a hawk, rather than having this sort of nebulous portfolio full of all kinds of things that I've sort of half interested in and then lost interest in over time. I've been there, I've done that. Even when the odd one comes along and it's just an absolute cracker, it was too small to ever make a difference. And it's sort of like, if I'm going to do that, but just buy an index and you'll go well, but you just don't have any of the work or any of the stress with it, right? So I want to outperform the market. I feel as though I need to be, to a degree, reasonably concentrated. And if I'm going to be concentrated, I need to be super, super, super fussy. I need to put a lot of effort into it to make sure, at least increase my odds as best I can, that I'm at least, along the right path, and be hyper aware of what being wrong looks like, so I can, back to our original point, act quickly in case the future doesn't unfold in the way I foresaw.
So when you're finding something that you really like, do you then wait for the right price? What's your process there?
Yes, I do. Well, I've got to be careful here. I'm not waiting for a pullback. I'm not waiting. I'm not looking at the current market price and going, I want it to be cheaper than that. I've got no idea where the market is going, and no one does. Anyone who tells you that is lying to themselves or to you, or both.
You can't see 4 inches into the future.
You can't. I mean, I've been in this game for 30 odd years now, and I've met all of these people, and the soothsayers they're wrong all the time, except, in fact, they're right to the degree that you would imagine, random probability to make you right. Like we roll a dice a bunch of times. We roll a dice 1,000 times. I'm going to call it correct 1 in 6 times. Like, that's just probability for you. So no, I'm not trying to predict the share price, but I've very much got a very keen eye on value. You can do really bad as an investor by buying the best company in the world if you overpay for it. Is NVIDIA a good stock? A good company? Yeah, it's a fantastic company. Is it worth $30 trillion? No, it's not. Is it worth $1? No, it's not. Logically, somewhere between $1 and 30 trillion, just to pick a stupid number, there's a price that makes sense. And so I want to figure out what that price is, or more accurately, what those range of prices are, because I'm never going to be able to work it out. So yes, that's a whole other conversation, but I do a lot of it's the final step of the process. The first part of the process is, what is this thing? Do I understand it? If I can't understand it, there's no point going on. If I do understand, I think I understand the business, how it makes money, then it's a question of saying, well, do I think it will continue to succeed in the future? And then if I think that's true, then it's, okay, what price is a sensible price to pay? And it's only at that point, having done that work, that I'll go look at the market and go, okay, I like the company. I like its prospects. I think this sort of a ballpark price or lower is a good deal. What's Mr. Market offering me? Oh, he's offering me something that's 40% above what I think is reasonable. So in that instance, to answer your question, I'll wait. I can wait a long time. It might be that Mr. Market's actually offering me a huge discount, or he's just more or less in the ballpark of what I think is fair. And in which case, absolutely, I'll buy it. I'm not going to nickel and dime it. I'm not going to worry about, geez, I thought it was fair value or intrinsic value, as people like to say, was $4.32.3, and it's at $4.50. I'm not buying it. I mean, it's so close as to be silly at that point. But if it's at $6, then okay, that's a little bit out of there. So I'm trying to be. What am I trying to say here, Phil? I'm trying to say you want to be generally right as opposed to specifically wrong. And this is a game where people love false precision. Again, imagine you and I are both selling services here, right? And your client comes to you and goes, do you like this? He goes, I do. I've done a hyper detailed discounted cash flow model. I've done a big industry and competitor analysis. And I've worked out that this stock's true intrinsic value is $6.87.9. Whereas I go, geez, I really like the business. I think it's got a good future. It's probably good value somewhere around $6, give or take 20, 30%. I mean, it sounds too reckless. It sounds too vague. And believe you me, I would far prefer a far more precise understanding of value. But it's something that you can never know, because you can't know the future. Value is predicated entirely on understanding the future. If any model that you want to present to me for evaluation, it's garbage in, garbage out. The model is the model, right? But if I'm plugging in growth rates that are unreasonable, or a share count, or whatever variable I want to put in that's nonsensical, I'm going to get a rubbish answer. But it will feel I've done the right thing because I've built this complicated spreadsheet and I've put in my best guess of these assumptions. It feels like a rigorous process. It feels scientific, but the world is not that precise. The future is not that clear. So look, I've always thought if I'm buying, and I like my small cap sort of growth companies, if I'm right on this thing and it's say at $1 a share, in the future, it's going to be $5 or $10 a share. I mean, do I really care? If I buy at 50 cents or if I buy at $2, I mean, anywhere in that range, I'm going to get a really good return. By the way, if I'm wrong and this thing is going to go bankrupt, Well, again, if I buy it at 50 cents or $2, it's going to zero. It's 100% loss on there. So, this false precision, and again, I've learned this the hard way, more often than not just kept me out of wonderful investments or make me take profits on wonderful investments. You mentioned Pro Medicus before. I got way too obsessed with value on that thing. And again, you don't want to disregard value, but you will get yourself in trouble if this false specificity will get you wrong. So, yeah, generally right, not specifically wrong.
I've got to get back to the chainsaw. And being a stubborn male, I'm trying to work out how to put the chain back on,
yes, it's an
which
art.
I spent hours wrestling with last night. So being a stubborn male, I'm going to read the manual this morning.
So can I give you, you've probably figured this out, but I was a bit slow to the party. Sharpen the blades.
This is a brand new blade, but
okay.
I've got a blade sharpener. I've got a Dremel with a blade sharpener tool on it as well, which I enjoy. That's a really nice little job to do as well. Nice, peaceful kind of job.
It's very zen, and
yeah.
it's very.
I've got a workbench. I've got a workbench now.
Me too.
Well.
It's so cool, right? It's great. I mean, it's very Lincoln-esque. What does he say? Give me 6 hours to chop down a tree, and I'll spend the first 5 sharpening the blade.
That's right. Yeah,
it's so true in so many things. But I'll leave you after this. But it's very true in investing as well. Spend most of your time thinking about it, sharpening the blades. Then pull the trigger. We're all too keen to just start whacking at the trunk of the tree with the axe. And it's just sort of like no. Do the preparation first. And then when you get to the business end of things, it'll be so much a better process. So, yeah, keep the axe sharp.
So tell us about Strawman quickly. How can people find out more? We've had you on many times before, of course, but we get new listeners apparently sometimes.
Yeah, just go to strawman.com. Look, I never give it a hard sell because the reality is, Phil, it's not for everyone. We're just shy of 500 members. So here's the pitch, right? I said to you before that there are certain pitches that generally don't work too well in the market. My pitch is join Strawman. It's rather expensive. We won't give you any advice. In fact, we expect you to share a bunch of your ideas and your research. But if you collaborate,
I love counterintuitivity.
Yeah, but I mean, that's why I say it's not for everyone. If you're the kind of person that just wants a hot tip, it's not for you. But if you want to engage and collaborate with some pretty smart investors, and it's all very transparent. We track everyone's portfolios. We want to be a meritocracy. If you want to share ideas, challenge ideas, that's why it's called Strawman. I set it up so I could put my dumb ideas out there and people could knock them over, because one way or the other, if they're wrong, they're wrong. And I can find out by losing money, or I can find out by someone telling me that I've made a miscalculation. So yeah, we're just an investment club. And if that sounds of interest to you, check it out.
Yeah, I love reality. We're just being really blunt about things as well, rather than doing hardcore marketing.
Oh, absolutely. You get the clients you deserve, I think. There's some places that do the big hard sell, and their churn is like 90% because they get people who are there with unrealistic expectations that can never be delivered on. And I've been there, Phil. I've done that.
That's another warning for listeners. That's another warning. There are so many people trying to get money out of your pocket by promising riches.
Yep, absolutely. Those that can do, those that can't teach, or something. Is that what it is? Or maybe I should say those that can't spruik. You've got to be wondering why. That's one of the rules for me. If there was ever a fund manager who didn't have the majority of the wealth in their own fund, that's an instant pass for me. It's sort of like, well, how can I be expected to dedicate any serious capital to something that you yourself won't do? So, yeah.
Yeah, my wife is a remedial massage therapist, and sometimes, not to do with her work, but there's other times because she's always in the garden, and I'm trying to record a podcast and I'm hearing some sort of chopping or hitting or whatever. And I say to her, I'm trying to record a podcast, and well, haven't you got a mute button or something? And I said, well, I try and be quiet when you've got clients. And she went, don't bother. It's not a day spa. And I said, you should have that on your website. Blah, 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 remedial massage. Yeah. It's not a day spa.
Love it.
Okay, Andrew, great to chat again, and enjoy chopping and sharpening.
I will.
Sharpening in every aspect in your life.
Absolutely, and you too. And thanks for having me on, Phil. It's always fun.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.